Hi everyone, in this video we'll be starting with the chapter number 29 of CMT level 2, Selection of Markets and Issues, Trading and Investing. So in this chapter we'll talk about what is the differences, what's the difference between buy and hold, position, swing and day trading, and we'll use how do we use technical analysis in each ways of trading or methods of trading with different time frames. We're going to compare significant factors in trading stocks and how is it different from trading the futures instead of the stock. And we're going to distinguish between bottom up and top down approaches, and then we'll see what is cyclical emphasis and secular emphasis, and we'll also talk about intermarket analysis, relative strength analysis, and the four methods of calculating relative strength. Before watching this video, make sure that you've checked the previous chapters. If you haven't, then I've linked it in the description box below. So now we have reached the stage in technical analysis where we become more practical. After learning how to analyze the long-term stock market and how to use various technical tools to determine the best entry and exit points in individual issues, we now focus on exactly what issues to consider for trading or investment goals. Those interested in using technical methods in markets must determine whether they have the time, inclination, and facilities to trade issues, or whether they want to consume less time and utilize technical methods for investing over long periods. So let's first talk about which issues should I select. Now, everyone will have a different criteria of what really suits them or what really works out for them. So it can't be generalized. It is always dependent according to that particular person, and it is always dependent on what the um, goals, personal goals that particular person has. Your goals might be different from my goals. Investment requires a certain aspect of the investor's time and energy, not mention knowledge and psychological makeup to profit. Investing, including trading, breaks down into four general categories. Let me try to use this. Okay. Yeah. So the first thing is buy and hold, buying a particular stock or commodity and holding it for a period of time. The second thing is position trading, and then we have swing trading, and then we have day trading. So these are the four kind of things which we have, four kind of issues. The amount of time and skill necessary increases as you go down the scale from buy and hold to day trading. Buy and hold, basically a fundamental exercise in company and economy analysis, can be done once a year if necessary, but more likely once a month, and drawdowns are a little of concern because if the portfolio is properly diversified, then then whatever price declines that occur will likely be reversed over time. Buy and hold is basically a longer term thing like investing. Position trading takes more fundamental and technical research because the positions will turn over more frequently and usually an exit strategy is necessary. Here you are position trading. You are creating a position in a particular stock and you will exit as and when required. So it is not like a extremely long period of time, but it is for a considerable period of time. And here one more thing what you do is that a good exit strategy should be in place, and technical as well as fundamental research is taken into account. So, exit strategy is necessary, forcing the investor to watch positions more closely, say once per month or every few weeks. Weekly charts are the most productive technical charts because the position investor or traders is not interested in the daily price oscillations. Swing traders hold a position between one day to several months, but most likely only for few days or week. We all know what swing trading is. This method requires daily charts and daily inspections of patterns and leadership. Finally, day trading. Day trading is same day buy and sell. It is completely technical and it is based on technical criteria such as price, volatility, tendency to trend, liquidity, volume, and so on. So, before you select issues, you must decide what kind of investor or trader you want to become. So, whether you like to hold position for a long period of time or whether you panic if you want to hold something overnight and you don't like to carry the risk when you're going to bed. So it really depends on your particular mindset and what kind of a risk appetite you have and what kind of aim do you have and what is your particular psychology like. Trading, swing and day trading. Day trading requires a complete commitment to the markets. It requires time every day and night, whereas swing trading requires a daily commitment that can still allow time for a job. Day trading requires constant attention, right? You need to be in front of the charts during the timings, right? Excellent execution abilities and high speed price reporting. It is not for everyone, and it is not advisable for people who have other jobs and limited time to commit. Day trading can be accomplished through mechanical systems that are developed for that purpose, but even then, a heavy time commitment is necessary to perform the executions, to monitor the system, and to develop new systems. The wise swing and day traders will select more than one issue to trade. In the stock market and the futures market, diversification is a necessity for many reasons. First, when a single issue becomes dormant in a small trading range and it is difficult to trade, other issues with which the trader is already familiar can take its place. Second, following more than one issue increases the odds that a profitable trend will not be missed. Diversification, especially in issues that are not correlated, reduces the risk. Thus, when screening markets with the criteria discussed next, anywhere from 3 to 10 issues should be selected, watched, and traded. So, you need to have a diversified portfolio, and you need to have a number of things which you are looking at while you're trading. You shouldn't just stick to just one particular thing, because, in that sense, you might not always be profitable. So, you need to have more issues. So, when you are trading only one issue and using more than the suggested initial capital in that one issue, then there is a bigger chance of failure, right? Because if that one issue goes in stop loss, then everything is gone. Some traders, rather than concentrating on just a few issues, would prefer screen through the entire marketplace for issues showing signs of impending trend change. Some people don't have a watch list only; they have like a um, free will, and they're allowed to choose whatever, wherever, whichever instrument is giving them their um, signal to buy or sell. They program the computers to search for new highs and lows, gaps, 1 and 2 day reversal patterns, range, volatility, and etc. So they basically use various sorts of screeners in order to identify a particular stock which they can trade today. Choosing between futures markets and stock markets. A swing or day trader must also make a choice about whether to trade in the stock market or the futures market, or if you want to trade in both of them. This choice is a personal one. The trader must consider a number of factors when making this decision. These factors include costs, personal risk preferences, preferred time horizon for trading, familiarity with each market, access to proper equipment, execution capability, and so on. So, first, let's talk about the cost which is involved in stocks, as well as the cost which is involved in futures. Trading is grueling and time consuming. It is not as glamorous as some recent movies make it out to be, like Wolf of Wall Street, and like the way these YouTubers portray it to be like a game. It's really not like that. This is far from the way it is depicted in movies. It is quite some work. Aside from the emotional strain of having to make instant decisions and instant executions, trading has numerous hidden costs that add up because of the many transactions which are necessary to profit. These transaction costs go beyond the commissions paid to the executing broker. So it's not just the brokerage which you are paying to the broker, there are various other costs which are involved, because if you do day trading, then more transactions are taking place rather than the less transactions which would take on a longer time frame trading. So the first cost is the initial setup of equipment. So if you want to trade, if you want to be a proper trader, you need like a laptop, or you need like a desktop, and you need trading view, for example, or you need these sorts of things. Like right now you are studying for CMT, right? And that's your another goal is to become a better trader. But for you to buy the CMT books, or for you to access this video lecture, you have um, obviously invested some amount of money to get this. So there is a lot of cost which goes behind setting the equipment. To trade, you must not only have a high speed computer, excellent data feeds, and reliable quick execution capability, but you also need a backup. You cannot afford to have your system go down during a short term, especially intraday trade. Like imagine you're taking a trade and like suddenly there's a power cut, then that's going to really cause a lot of losses if you don't have a proper Wi-Fi connection when you are trading, right? Other costs are commission, slippage, missing the intended price during the fast market, limit days, unexpected events seemingly always occurring at a critical juncture. For example, the dog pulls the wires out of the computer, the cat walks across the keyboard, and so on. So these are the various kind of costs which are actually involved when you actually go into trading. It's not just commissions which you're paying to the broker, it is far beyond that. And then we have the second topic let's discuss, which is the risk. Like, how much risk are you willing to take as a trader or as an investor? So, everyone has a different type of risk tolerance, right? So, futures are considerably more risky than stocks because they're usually traded with a very high leverage. You know that. Leverage is basically the amount of capital that can be borrowed to initiate and carry a position. So you are taking up a position which is much more than what you can actually afford. So if a loss happens during then there's a very quick chance of your entire capital to get wiped out in your account to be blown. So with futures, the danger always exists that an adverse move will eliminate the trader's protective margin, requiring the trader to come up with more funds or be stopped out. Stocks can also be leveraged, but usually not to that degree. Like if you check out the Zerodha brokerage, you can see that they'll just give you a leverage of 1 is to 4, right? But when you talk about futures, you have leverage even up to 1 is to 1000. So that's quite some, that's like a lot. So however, stock trader also can, you know, they can obviously also become a loss making traders, but the only difference is that futures have a higher and a more quicker, you know, time to get broke as compared to the stock traders. Now let's come to suitability. Your experience in the markets determines the issues with which you are most comfortable. For beginners in technical trading, the slowest and the least risky markets are the best. So, what is suiting you? You need to check that out. Once your trading experience provides you enough confidence, you can enter other faster and more risky issues. So, starting with something which is simpler, for example, starting with equity instead of just directly starting with forex or directly starting with futures and options, starting with equity. Now, these are the kind of things which you need to be doing. Suitability also encompasses time available. How much should one be invested in fancy code and execution equipment, and so on. It is based on personal choice and preference. The third aspect is the time horizon. Now, that is again subject to each person and what they think is right. Day trading has many methods, like you have scalping, which means in and out of the market within seconds. You have patterns, trend lines, support and resistances, analyzing short term patterns, or using, let's say, indicators. There are hundreds of methods to trade, right? So scalping basically involves taking small profits between the bid and ask price of a stock. It requires close attention and excellent execution and fast feed charting equipment. Sometimes you just exit into from a position within like a matter of 5 to 10 seconds, so it is like that quick. But again, while it seems exciting and while it seems like quick profit, you need to also realize and you need to also keep in mind that that also means that there is a chance of an easy and a quick loss as well. Okay, now what is regular day trading? Regular day trading is an issue and closing all positions by the end of the day, which means that you are buying something today and you're selling it today as well. So you're closing your position within the same day. It has an advantage that there is no overnight risk, right? Like there's nothing overnight risk. So you can go to bed peacefully and you don't have to worry about any open positions that are there or what might happen in the market tomorrow or what might happen in the market the following month or the following year or even the following week. You don't have to worry about all that because you're in and out of the market within the day, so there is no overnight risk. However, a variation of day trading is called screen trading. Yeah. Screen trading uses technical analysis intraday shown on a computer screen to give signals. The bar lengths are determined by the trader's ability to react quickly and accurately. Most commercial intraday technical analysis software divides trading into single tick by tick, 5, 10, 15, 60-minute bar lengths. These are basically the various time frames of the candlestick charts, right? From this data and software, almost any indicator or pattern can be programmed and used to identify the software. Almost any indicator or pattern, which means it could actually be anything. However, it requires the time to watch the positions all day and equipment necessary to execute and watch the trades. Nevertheless, day trading has become popular. The new automated electronic exchanges, where trades are executed immediately against the trading book, have revolutionized day trading and made markets more accessible to non professionals. Earlier, you know that there were no discount brokers, or there were no mobile phones where you can just sit in your home and then you can trade. Earlier, people had to go to the stock exchanges, and like they had to trade using a paper, and there were no softwares like this, and there were no charting techniques like this. Like people used to just um, you'll have to go to the cyber cafe, and even before that you'll have to trade using a paper. The charts were never plotted before. People used to actually draw these charts. People used to draw these candlestick charts using their hands. So that's how it used to be before, but now it is very advanced and very modernized, and even a normal person, a layman, can have access to the markets, which is a very good thing, but it is also a very detrimental or a dangerous thing, because anybody can lose their money as well if you do not educate yourself properly. And if kids, when I say kids, like if 18-year-olds just go into the market without any sort of research and studies, then they will lose their entire money, which is um not nice thing. Chicago Mercantile Exchange is an excellent example of a futures contract that is executed almost instantly and has a margin requirement considerably less than its earlier, larger version. Swing trading is more easily accomplished by amateurs. So, somebody who's just beginning out, then you need to start away with swing trading, because the swing trading is a decent time frame, because it's not as tiny as a daily, and it's not by daily I mean intraday, and it is not as big as long term investing. So this is something which you can start off with, and then slowly and gradually you can move to day trading, and then maybe if you were interested to check out scalping and so on. Okay, now let's see the next one, and that is volatility. Now, what do you understand by the term volatility? As we saw in some short term trading patterns, low volatility is a difficult world in which to make profits. The breakout from low volatility to high volatility is where most of the profit is derived. Therefore, futures or stocks with low volatility are generally not good choices for trading. The transaction costs of exit and entry, the possible mistakes in execution, and other costs demand. So, if something is not volatile, and if it's something is a dry instrument, then there is no way that you can actually make money using trading that instrument. So, you need to always check for how volatile that particular instrument is. Next, we come to the liquidity. Now, liquidity is the presence of buyers and sellers, whether the buyers and sellers are present or they are not present.